5 top investments, no time to waste, and no holds barred. That's the challenge we've put to DIY investor Matt Shoss. He'll have just 15 minutes to defend his best investments from yours truly under the bright lights. So, can he make his case in time, or will he crack under the pressure? I don't know, Matt, what do you think?
We're going to give it a shot.
All right, let's get to it then. This is Inside My Portfolio. Hello everyone, welcome to a special episode of Inside Investing, one we're calling Inside My Portfolio, where we challenge everyday investors to defend their top investment picks in 15 minutes or less, and along the way, help you learn how to make savvy investing decisions of your own. I'm your host, Rob Moise, and as always, this show is presented to you by TD Direct Investing. Joining us this time is Matt Shoss. He's a 22-year-old DIY investor who shares his investing journey and insights to over 200,000 followers across social media. And get this, he's also the co-founder of Dragon Fruit Ventures, a venture capital firm investing in North American tech startups. Matt, welcome to the show. It's great to have you here.
Thank you, Rob. It's been a long time coming. I'm excited to be here.
That's right. Thank you for being our first victim. Our special guest, of course. How are you feeling? You excited for it?
I am super pumped. I'm super excited to dive into things and have you rip apart my portfolio.
Maybe it won't go that harshly, but we'll see. I like the fighting spirit, though. That's great. And Matt, I got to say, you're wise beyond your years because you started investing when you were 18 years old.
That's right.
So you got a few years under your belt already. I was wasting all my money at the campus bar when I was 18, 19 years old. So you're way ahead of me. But I'm curious, what got you started investing so early?
Yeah, I think I always had this obsession with money since I was growing up. I got my first job at McDonald's and then at a gym, and I was trying to earn as much as I could, as early as I could, and put that money away to save. And as I started to save some money from, that McDonald's job, I wanted to figure out what to do with it. And so I was on YouTube searching up things to do, how to save money, how to invest money, how to make more money. Stumbled across some incredible finance creators, some of which have been on this show, others from the States, Graham Stephan and whatnot, and I kind of got started down this big rabbit hole of personal finance, and here I am.
Yeah, it can be quite a rabbit hole, certainly. They say that the best time to invest was yesterday, the next best time today.
Absolutely.
So you're way ahead of the game there. I think it's really interesting, too, that you are a venture capitalist, sir. I think a lot of people would probably do a double take when you tell them that. You got the quarter zip sweater, so you know it's official.
I look the part.
There you go. But that's a tough industry, right? You got to run with the big dogs who've got a ton of experience and probably money behind them, connections. How are you going to play in that world?
Yeah, I think our fund has a really unique advantage with us being young. And so the spaces that we're investing in, like consumer tech and the future of work, those are spaces that we as the younger generation can understand. We've lived through them. We know how to spot trends, how to pick up on things quicker. We kind of know what the future of work looks like, at least currently. We have people, friends that are working those jobs in consulting and accounting and banking that may be affected by, the future of work and what that looks like. And so as a fund, that kind of gives us a first mover advantage, insights that other funds may not have. They may have to call up friends or call up customers. We have lived those experiences. And so that ultimately gives us a leg up as a venture fund.
That's a really interesting value prop. Good luck to you guys, of course. It's a dog-eat-dog world out there, but let's see if you guys can get it done. Of course, we're going to hear about the investments in your portfolio in just a moment, but maybe give us the bird's eye view of Matt Shoss, the investor. What are you all about? What's your strategy and your timeline, your goals, all that good stuff?
Yeah, absolutely. So I think the easiest way to put it with my stock portfolio specifically is I am a very boring investor. A lot of people are, asking which stocks do you hold? Are you buying individual stocks? Are you investing in crypto? All these other asset classes. The reality is no. 80 to 90% of my portfolio is in broad market index funds and ETFs. That is the reality. That is kind of what I stand by. And of course, we're going to dive into that. Now, my situation is a little unique because I work in one of the highest risk asset classes in the world, and I also have exposure to some startups and some venture investments. And so that kind of, is where most of my risk and volatility is when it comes to my portfolio. And so my stock portfolio is a little, safer in my eyes.
Mm-hmm, yeah. Although still, we were talking off cam and you said, roughly 7 out of 10 on the risk scale, still a pretty healthy risk tolerance too.
Yeah.
Tell us what are some of the things you're investing for?
Yeah. So, immediate goals, when it comes to my investing strategy, I never like to put hard timelines on anything because the reality is everything can change. You get a new job opportunity, you have to move, you start a family, like things get pushed or they get expedited. And so when it comes to like financial goals that I have, of course, coming up, it's going to be a house probably next, wedding costs. We know those are expensive now potentially, fingers crossed that one works out, but things like that. And ultimately it's just saving and investing so I can enjoy life, whether that's in 2 years from now, 10 years from now, 40 years from now when I'm retired and doing whatever, able to travel the world. Ultimately, it's just saving for no purpose, but more of like the broader purpose.
Right. Yeah. So a mix of like long and short-term goals. I think that describes a lot of people, frankly.
Yeah.
What about investing accounts? Where are you actually putting your investments in?
Yeah. So right now, in terms of the registered tax-advantaged accounts, I have my TFSA, my FHSA, and my RRSP. And then maxing out all those accounts, I also have some in a non-registered account as well.
Okay. So juggling a lot of accounts, a lot of different goals and stuff like that. We're going to dive into all of this in just a moment. It's time for the main event, all right? You gave us the bird's eye view. Let's get to it.
Let's do it.
And just for our audience, here's a quick refresher on how this is going to work, okay? Matt is going to have just 3 minutes each to explain his top 5 investments, and his goal is to give us the best defense of his investments and his rationale behind it as he can before the timer runs out. And along the way, I'm going to be challenging that rationale to help you, the viewer, understand why he chose those investments. And of course, Matt, you're not going to be fending off just me. We have our viewers as well, too, chiming in on our live viewer Q&A. This is something that we do every show. If you're watching on Webbroker, you can use the questions box to send your questions to us on our broadcast platform. It's the questions and comments box, and on our YouTube live stream. You can follow the link in the description. It'll take you over to the broadcast platform where you can ask your questions. We're not going to be able to give you stock picks and stuff like that, but if you want to ask Matt about the investments that he does discuss on this show, get a little bit more detail about them, or just his investing strategy in general, of course, send those to us ASAP. And one last thing before we get rolling, I would be remiss if I didn't have a disclaimer for everybody, of course. We are going to be asking Matt about some of the investments that make sense for him based on his unique investing style, time frame, risk tolerance, goals, all that good stuff. So they may not make sense for others and therefore should not be seen as financial advice. The idea here is that we're going to give you food for thought on how an everyday DIY investor makes his investment decisions to help you on your own. With that said, Matt, you ready to rock?
I'm ready to go.
All right, let's fire up the timer and let's go inside your portfolio.
All right.
So the first investment that we are going to discuss is ZSP. This is a S&P 500 index ETF. Tell us about it and why you hold it.
Yeah, absolutely. So when it comes to investing, the gold standard is the S&P 500. Historically it has returned between, say 7-12%, accounting for inflation, whatever, roughly per year in terms of returns. And so when it comes to building my stock portfolio, again, I have a more longer term outlook with a lot of my investments, and I also want to kind of minimize taking heavy bets on individual stocks. And so the S&P 500 is, in my opinion, the gold standard, and that is where the bulk of my portfolio sits because I see it as, long term, relatively safe, less volatile than picking individual stocks. And honestly, it's boring, and that's the way I want it to be.
Sometimes boring is beautiful. Right?
Absolutely.
I mean, certainly the historical track record of this thing has been impressive, no question. That said, some investors are a little bit concerned right now about potential overvaluation in this index, particularly the big dogs at the top of the index, all those big tech names that we're all familiar with. The thought being that if something goes wrong with those guys, they're going to drag the whole thing down. Is that a concern for you when you were investing in this initially? Is it a concern for you today at all?
Yeah, I think every investor should be mindful of, the quote unquote AI bubble that, everybody thinks we're in. The reality is, yes, we are probably in a bubble. I don't think there's any denying that. I don't think anyone on the world is denying that we aren't in a bubble. But the matter of when it's going to pop or how big it's going to be when it does pop, nobody can say for certain. And so I would say that the companies that are, pushing the S&P 500 forward and, increasing the valuation by so much, those top tech stocks are there for a reason, and that is because they are developing the technology at a forefront of what is to come, and that is AI. And so I think they are there rightfully so. In my perspective, it's not something that I really deeply, fret over, because the reality is the way I see things is that if the bubble does pop or when it does pop, we don't know how much it's going to be, but I'm also okay with being exposed to all those companies because AI isn't going anywhere. Those companies are still going to, I think, perform in the future. And I don't see a world where those companies are non-existent. I don't see it.
Right, and I guess if those falter a little bit, you do have the other 493 odd companies to help
Exactly.
you diversify things a little bit. We've got about 45 seconds left, Matt, but I want to get your take on a strategy that's very popular. S&P 500 and chill is sometimes the moniker that it's called. All I have is an S&P 500 index fund. That's all I invest in. It's the entirety of my portfolio, and I just keep on keeping on. What do you think about that strategy? Silly or stupid?
I think,
sorry, savvy or stupid?
both. So I think everybody has to reflect on what their goals are, of course, and set their own financial milestones, or really come to a conclusion of what they want to spend that money on. What is the goal? But overall, I'd say for 90% of people, it's probably a very viable strategy, and frankly, one that I think most people should do. They should oversimplify investing. It shouldn't be something that you have to think about and constantly change and worry about. It should be carefree. It should be boring. And yeah, that's it.
That's time. That's good, and certainly for long-term investors, that can make some sense to kind of just keep the big picture in mind. Let's get to your next investment. This one is ZQQ. This is a Nasdaq 100 index ETF. Sticking with the index theme, tell us about this. Why did you choose to invest in this one?
Yeah, so ZQQ, of course, is more. It's focused around the growth, and right now that is tech stocks. And so for me, having more exposure into the tech sector, which is a space that I love right now, and I think those companies that are in the tech space right now, especially the larger ones, are going to be around for a while, and they're going to continue to kind of set themselves apart from the rest of the pack. And so I am comfortable taking on a little bit more volatility, or quote unquote risk, and investing heavier into tech to get more exposure to those big and winning companies that I think are going to perform and continue to perform well.
Right. I saw an interesting survey among CEOs saying that over half of them saw no tangible benefit from their AI investment so far. Does that not freak you the heck out?
No, it doesn't. And I think for a variety of reasons. Number one, I think everything is still very early. And number two, when you're investing into something like the Nasdaq, the difference between my portfolio and, say, those managers that are making those reports is they likely are picking individual companies, and they're not hyper diversified. Whereas when you are investing into something like the Nasdaq or the S&P, you have a collection of hundreds of companies. And so, yes, their picks may not be overperforming or performing to standard, but the other companies in the asset class or in the ETF, for example, do have the opportunity to kind of carry those forward. And so, again, that's not really something I worry about. I just like to stick to my strategy and thesis that I believe in and go from there.
Well, I kind of want to push back on that a little bit because the Nasdaq had a horrendous crash at the turn of the century, 2000, 2001.
Yep.
It took 15 years for the index to recover. So we're not talking individual stock picks. We're talking about the whole thing. That's a long time, even for a long-term investor.
Absolutely.
Let's say that kind of crash happens again. Like, what do you do with your portfolio?
I think that's where it comes down to setting yourself up preemptively before that crash. And so when I'm investing money into the stock market, I take the approach of, okay, 5 years, if I need the money within 5 years, I'm probably not putting it into any sort of stock or ETF or anything regardless. We can chat about that later, but with the money that I need beyond 5 years, that is the money that I'm putting into the stock market. And so it kind of hedges slightly against that. Of course, if we're down for another 10 years beyond that, then that's something we have to kind of consider. But with the strategy that I have, even with the long-term downturns that could happen in the future, it has bounced back. It's bounced back after that 10-year period. And I don't necessarily need that money.
Yeah, okay. Again, so keeping the long view in mind. We've got about 30 seconds left. Here's a question for you, bro. Where is your Canada? All right, you got your American indexes. I thought you were a patriot. Well, how come no Canadian stocks?
Yeah, so for me, again, it's, I would love to support Canada. I would love to support Canadian companies, but I think a lot of the Canadian companies, when we look at, the top ones, Shopify aside, a lot of them are big banks, big energy companies, and they're high dividend paying stocks. And as a 22-year-old investor who is looking to grow my portfolio, dividends aren't necessarily what I'm looking for. I want to be, putting my money where the highest growth potential is. And the reality is, I hate to say it, Canada, but that's not here right now. The opportunity is in the US.
Okay. Let's move on to your third investment. This is doubling down on the tech theme. This is Meta Platforms, also formerly known as Facebook. A lot of people might be familiar. Why did you pick this one? Yeah,
ultimately it comes down to a great founder and founding team. So I have a lot of faith in Mark Zuckerberg, like him or hate him. I think a lot of people have takes on him, but he has shown countless times over and over again, his metaverse example where they invested billions of dollars into building out this metaverse platform, but he's shown that he's able to kind of stop things if they go wrong and kind of, just accept the loss and move on and pivot into something else. And I think he's shown that with their development of their own internal AI tools and their acquisitions and their new hires. They're trying to be extremely competitive. And, as a VC, that is what I look for when I invest in early stage companies. And it's still what I look for when I'm picking my individual stocks. It's just incredible founders.
I got to pick on the metaverse, though, because, they believed in this thing so much that they changed the name of the company. And then it proceeded to face plant very, very hard. Like, how can you have confidence in a management team? That could be that wrong.
I think when you look at the broader picture, yes, it was a sizable investment into something that ultimately didn't work. I would rather put my money with founders and companies who are willing to take a bet like that on something they truly believe in than companies that are just too afraid in general to experiment with new things, because that's how you get left behind. We've seen it countless times with companies in the S&P, or even companies we're seeing now that have kind of refused to adopt AI or different workflows and everything. And so I would rather invest in a company that, yes, they made an investment, it lost, but it's still a very successful business in its own form, and they have the opportunity to, again, reinvest into other avenues as well still.
It's certainly a very diversified one. And like you say, they are one of the forefront AI companies. That said, they don't seem like they're the best at AI currently. So, why do you see this as the one to pick? Is it just go back to the leadership team aspect?
Yeah, it goes back to the leadership team aspect, but I think something that Meta has that a lot of other companies, AI companies, don't, for example, your OpenAIs that are probably going to go public in the near future, the reality is that they have another business model. AI is kind of this added layer on top. It's a new avenue they're exploring. It's the same with the goggles and the metaverse and the whatever. Apple makes phones, they're experimenting with XYZ. Meta is the platform, it's a social platform, and they're experimenting with AI right now. And so for me, it's also a little bit of a safeguard and a hedge. It's they still have WhatsApp, they still have Instagram, they still have Facebook, and that is where the bulk of their revenue is coming from. So yes, if AI doesn't work, sucks for them. But I also think that they're going to figure stuff out. I think they have some really, really cool partnerships going on, and I have trust in Zuckerberg and the team there. So
right on. Just 30 seconds left. Speaking of Facebook, it's sometimes perceived to be the old people's social network, certainly the place where a lot of crazy uncles seem to congregate for whatever reason. Are you not worried that this cash cow for them goes the way of MySpace eventually? Something else usurps it?
Yeah, so when it comes down to Meta's revenue, I think it's something like 90-something% or something comes from advertising. Now, a lot of that is on Facebook right now because that is still where, people are pushing ads, but they also own Instagram. They own these other platforms where they can push these advertisements. And so I think that gets diversified long term. People leave Facebook, they're just going to go on Instagram. That's where our generation is, and that's just how I see it.
Okay, that's fair. I gave you an extra 5 seconds.
Sorry,
I'm a really nice guy, but very well done so far. Let's get to your fourth investment. This one, we're talking all kinds of cool tech stocks and everything like that.
Yep.
Now you're talking cash. Cash is one of your top investments. Why cash?
Yeah, so the cash ETF that I hold, and the cash that I hold in general, is in what is essentially like a high interest savings account in the form of an ETF, or also including just my high yield savings account. And so that comes for a variety of purposes. For me personally, number one, it's for contribution for my future room in my tax investing accounts, the TFSA, the FHSA, the RRSP. It's also a place where I don't have a typical pay structure because I own the company I work for, and so setting aside money for taxes and whatnot is also a big portion. But I think the bulk of the money that I have in cash is being held there for the purpose of I have a lot of short-term things that I want to do. I don't want to put every penny away so that I can go enjoy it when I'm 60. I want to go enjoy things when I'm 22. And so I've had the opportunity to go and travel and do these incredible experiences and share things with my friends and family and do things for people. And that is what the cash is essentially for, is short-term things.
Okay, so yeah, the flexibility of cash is certainly nice, king, if you will. That said, is this not just a giant opportunity cost because you're not really getting any kind of return on cash, and inflation's basically just eating away at the value of this cash? Does that not concern you? Why are you okay to hold a decent amount of cash?
Yeah, absolutely. I mean, at the end of the day, it just comes down to my mindset, my goals, and what I want to do in the near-term future. Like I mentioned before, I don't like investing money that I have to hold for longer than, a 5-year period, or less than a 5-year period, sorry. And so with that money that I need within, the next 2, 3, 4, 5 years, 2 months, I don't want to put it in the stock market, frankly, because that is a risk in itself. I don't know where the market's going to be tomorrow, a year from now, 2 years from now, 5 years from now. You can more kind of predict where the market's going to be 10 years from now, and that's why I'm investing that money. But with the goals that I have in the short term, I don't want to put that into the stock market. I'd rather get a guaranteed return. Yes, inflation eats it away a little bit, but it gives me a lot of flexibility to enjoy life right now.
Right, sort of like a bird in hand versus two in the bush type kind of thing. That's
exactly
fair. Let's say that a market crash or a decline happens and you want to buy the dip. Would you raid your cash holdings, even if it could jeopardize some of those short-term goals, thinking like bigger picture, this could work out for me?
I think it depends how big that dip is. I think it would be hard not to. And again, that's just my personal opinion. I try to remove emotions out of investing. If an incredible opportunity presents itself, whether it's in the stock market or it's a cool company or whatever it may be, I think you ultimately have to take it. Now, that being said, I'd be very mindful of mapping out what my goals are. Like, I still want to enjoy things and do certain things in the next year, 2 years, 3 years. But ultimately, I would probably go and tap into some of that cash. Absolutely.
Okay. And here we are beating the clock this time. Let's get to your last one. This is actually a dud investment of yours, right? So we talked about the good, but we're equal opportunity here. We're talking about the bad. This is actually one of the first investments you made, Air Canada. Take us through why you invested in this one and why did it fail to launch, so to speak?
Yeah, so Air Canada was actually the first stock that I ever bought. I think I bought it on my birthday, the day I turned 18, opened my TFSA and bought it in there. So I put a couple $1,000 into Air Canada, which is what I had saved from my jobs that I had in high school and whatnot. Ultimately, why I chose to invest in it was I fell victim to subreddits and discords and Twitter rabbit holes and terrible guru advice. And so that is ultimately what led me to investing in Air Canada. I was a young kid. I was trying to make money. I was eager to make money. And so I was trying to find, my version of Tesla, essentially is what I was doing. And I thought it was Air Canada. I also had a little bit of a passion for aviation. I am a licensed pilot. And so growing up, I always liked planes and everything. And so I was like, oh, perfect. Like, this is the perfect concoction. It's a perfect reason to invest, and I'm going to be rich. And that's ultimately how I got there.
So what would you do differently knowing what you know now, if you could go back in time?
Yeah, I think one thing that I try to tell people and also tell myself sometimes, when you're scrolling on Instagram, you're scrolling on Twitter, and you're going into those Reddit channels and everything, is take everything with a grain of salt. A lot of the advice you see is from people that have a lot of their own investment into XYZ stock, and just really, really focus on education. I think when I was 18 years old, I didn't know what an ETF was. I didn't know all these other options and how to build a good diversified portfolio. I was just looking for my winner because I thought that's what you did. And so really, really take the time before you go out and invest yourself to learn the basics, learn your options, learn how things work, and go from there. That's ultimately what I wish I did.
Yeah, but at the same time, social media can be a valuable tool for investment ideas and research and stuff like that. You're a content creator. You kind of know how the game's played here. So what do you look for that tells you something on social media is credible versus not credible?
I think anybody who is, promoting single returns, or we can get into, people talking about crypto and opportunities like that. And, even options is kind of on that borderline where if you look at the data, the reality is most people that are doing that stuff or day trading or trading these individual stocks, a lot of them don't end up making money, or they don't end up outperforming, just investing into a broad market ETF. And so I think when it comes to getting your investing advice and where should you focus on, you just really have to, kind of take a deep step back and look at who is giving the advice, why are they giving the advice, are they trying to sell me something, do they potentially have, their finger in the pot, and, you investing in XYZ stock could, make their pot a little bigger. Just really take a step back and analyze who's giving the advice and why. Okay.
And then just really quickly with 30 seconds left, the investment that you made at the time in Air Canada, that was a lot of the money that you had, basically. Yep. How is your philosophy around that right now? How big would you let an individual stock position get today in your portfolio?
Absolutely. My rule right now, and again, it kind of fluctuates. It's hard to constantly average everything out, but my rule in general is 5% max, I think, to an individual stock holding. And in general, in all the individual stocks that I own, no more than 10%. And that's kind of my rule.
Okay, perfect. And right on time too. Well done, Matt. Fantastic. Thank you for taking us through those investment decisions of yours. How did you feel under the bright lights, man?
It was a stress, but we got it done. Hopefully the viewers are happy.
Maybe next time I'll sharpen my claws a little bit and get into you a little bit more. I thought you did a really good job, made it really easy for us. And it looks like you had fun too, right?
Absolutely did. Thanks for having me.
Absolutely. And I hope that our viewers had fun as well too. We got a lot more to get to, including that live viewer Q&A that we teased earlier. But if you're enjoying the show, you found it educational, make sure you check out TD Direct Investing on social media. You see the QR codes on screen. You can follow us on YouTube, Facebook, Instagram, all the places online. You can get a sneak peek at upcoming episodes and a ton of other content designed to help build your investing knowledge. Like I said, our viewer Q&A coming up in just moments, so get your questions in if you haven't already. But first, I want to bring in my colleague Caitlin Cormier to show us how you can get started building your own portfolio in TD Easy Trade. Caitlin, welcome to the show. Yeah, I think we have an audio issue with you, Caitlin. We're not hearing you quite yet.
That's okay, sorry.
Oh, there we go, there we go. The old mute button, all good. Caitlin, I'm gonna put you on the clock. Okay, you got 3 minutes to show us the basics of Easy Trade. So first off, how can investors find investments to consider on this platform?
Okay, I'll try my best. Let's hop right into the platform. Let's not waste any time. We'll go right into TD Easy Trade. So you'll see right here on the front page of Easy Trade as we get in there, there is even a button right here that says trade. So if you want to go ahead and click on that, you'll notice right under where it says symbol or name, you can type in if you have a particular company that you are looking for. But if you just click the browse stocks and ETFs, you can see a huge list here of different TD ETFs that you can invest in. Some of the ones that were discussed today would be available here. Like, for example, there's some cash ETFs. We've got our one-click type portfolios. And then as you come down further and further, you'd be able to find things like those S&P 500 type ETFs and that sort of thing. So a huge listing of ETFs, or I shouldn't say huge, but quite a large listing of ETFs. And then the next tab over is going to be your stocks. And if we talk about one that we talked about today, for example, if I type in Meta, I can see right here that that's going to show up as an option for me to kind of find more information about that particular company.
You see all the information about it before you make your buying decision. Okay, that makes sense. That's simple. What about investors starting out? They might not have a lot of money to play with. How can they stretch their dollar a little bit further when they're buying investments?
Yeah, absolutely. If we look at this particular investment we're talking about right now, $644 is a lot to have to buy one share. There's you have, like, for example, $1,000 and you wanted to put it in Meta, just simply click the buy button. And then when you get in here, you'll notice where it shows price type, there's a little kind of pie there that says partial. So instead of putting a number of shares, I can simply put in that I want to invest $1,000. It's going to show me how many shares I can buy. And then that way I can still put every dollar in right away to invest, but I'm not having to choose kind of individual shares. I'm not having to have, $1,200 plus to buy this. I can actually buy 1.5 shares with just that $1,000.
All right, that makes it really easy. Thank you so much. And to time, Caitlin, well done as always. That was Caitlin Cormier, TD Direct Investing's Senior Client Education Instructor. Okay, Matt, we're going to get to our Q&A in just a moment here. But for those in our audience, if you want to start investing, TD Easy Trade looked interesting to you, consider opening an account. You can scan the QR codes on screen for the Apple Store and Google Play. There's a lot to like in there. We got 50 commission-free stock trades. We have unlimited commission-free TD ETF trades, partial shares to put every dollar to work ASAP, like Caitlin was saying, and of course your choice of TFSA, RRSP, FHSA, and cash accounts. Probably a whole lot of other acronyms too that I'm sure we'll come up with eventually. Plus, there's a cash back offer of up to 2% on new deposits going on until March 2nd, 2026. So what's not to love about that? Like I said, scan the QR code. You can get full details too when you check those out. All right, Matt, the time is upon us, the live viewer Q&A. Let's see what we got on tap for us with this first question. This one coming to us from Sean. Sean is saying, why did you choose ZSP over other ETFs that track the same index? Yeah, there's a lot of S&P 500 index ETFs out there. Why ZSP?
Absolutely. So one thing to look for when you're talking about and analyzing different ETFs that all kind of track similar things is I think the biggest and most obvious is the management expense ratio, the MER. And so that is like the management fee that a ETF provider is charging you to essentially run the ETF. And so with this case, comparing some of the other top, S&P 500 ETFs, a lot of them are basically the exact same in makeup, in price, in management fee. And so it ultimately just comes down to personal preference at the end of the day. Do you want to choose Vanguards or TDs or whoever you want? They have an ETF. As long as everything is relatively the same, it's really just personal preference.
The one, difference in some of them is there's equal weight and market weight. The one that you invest in is a market weight SP 500 ETF. Have you ever considered equal weight, and what's that all about?
Ultimately, no, and quite frankly, that's just something I haven't really looked at. There's a lot of like minute little changes you can do with your portfolio as you're kind of constructing it, but a lot of them don't really have a major effect immediately until you maybe have a substantial amount of money in your portfolio. And I don't really consider even what I have right now a real substantial amount to the point where I worry about those little minute things. So there very well could be a better answer to give, but that is the truth. I just haven't looked at it.
Right. No, I mean, I think a lot of investors are in the same boat there. So good to hear your perspective on that. Let's get to our next question from Angela. Angela wants to know, what about alternative investments like crypto? What do you think about crypto? Do you invest in it?
So, funny story, I actually used to, one of the first startups and companies I worked at in my first year at university was a crypto gaming blockchain company. And so I was heavily exposed to that space. One of my friends got me very, very involved into crypto early on in kind of that 2021 era when everything was, going to the moon. And so I was trading everything under the sun, from NFTs and monkey pictures to crypto meme coins and everything. And, I made a ton of money. The next day, lost it all, made it all back, lost it all, and, round tripped a lot of it. Ultimately came out on top. But the reality is, at least the way I see it with a lot of the crypto investments, is not a lot of the coins. Bitcoin is kind of on its own pedestal. Yes, you can consider it kind of like gold and whatever. And I don't think it's a bad thing to have a certain allocation or exposure to Bitcoin. I wouldn't ever make it a large portion of my portfolio, but that's just me. But the rest of the coins, there is nothing backing them up. When you analyze a company, you can see their earnings, you can see their products, you can see what they're building. With a lot of those companies and those coins that are out, there isn't anything really tangible or fundamental that is propping them up to the valuations that they're at. And that's my take, I guess, in a nutshell.
Yeah, there are some epic live streams where somebody sees the rug get pulled right out from under them, right there. You can kind of chuckle about it, but you feel bad for obviously the people.
Absolutely.
So
it's real money.
Good perspective there. Let's get to our next question. What do we got on tap here? Yasha has a question. How do you value your investments through fundamental metrics, original research, or a combo of both?
Yeah, so I think one of the beautiful things about my investing strategy is that, like I said, 70, 80, 90, whatever it is today, I don't really know, but that percentage of my portfolio is in ETFs and broad market funds. And so I don't really have to do that stuff. I don't really have to analyze stocks. And I think one thing that beginner investors in general kind of, deal with, like a problem they have, is that people are trying to pick individual stocks. They're going through earnings reports and they're listening to live calls and whatever, and they're trying to get all this information. But most of us do not have the right background or the skill set or the time to do that properly to the level that the hedge funds are doing right now. And so that is why I stick to my broad market ETFs, but the things that I kind of know and understand and that I don't have to do deep dives into, because again, I am probably not the person that is going to go and pick individual winning stocks. That's just not my background. And I also don't really care to put the time and effort into doing that. When it comes to picking Meta and Amazon, I more so look at I think it's a blend of quantitative and qualitative. Meta, for example, my largest individual stock holding, that is more of a qualitative bet on, the founder, like we talked about. But there is definitely some cases where you will have to definitely look at the numbers and make sure the numbers are still good. But again, when you start doing that, you start to get pushed into that side of you got to know what you're looking for, which is, what a lot of new investors don't realistically have. Yeah,
it's a big undertaking to do it quote unquote properly.
Yes.
Certainly there can be a lot of work that goes into it, a lot of time, and I think it can be intimidating to people who they just want to get started investing.
Yep. You
don't necessarily have to be a stock bro to get into this stuff,
Absolutely,
right? So as your strategy tells us. Let's get to our next question. This one from Mo. Mo is asking, how do you learn to cut your losses on individual stocks?
Yeah, I think that's a great point and something that needs to be talked about more. And so the way I see it is, if fundamentally the reason why you invested in the business has not changed, that is when I personally would not cut a loss. I would probably maintain it. If they have developed a new project and they've pivoted and now they're doing something else and it's in the gutter, that's probably when you would cut the loss. But I think ultimately, if you are investing in an individual stock, it should be because you have massive conviction in what they're doing, whether that's a product or a price or a new service or how they're hiring, whatever it is, the reason that you're investing. If that is still the same, then I don't think that's when you should be cutting losses. I think you should, have conviction in your decision. But again, if that core thesis that you have is disrupted or put to the side, then that's when you consider, cutting it.
Yeah, I think the temptation is sometimes you look at a stock chart and you think of these things as lines on a chart going up and down, but like these are companies at the end of the day, right?
Yep.
So to your point, it's all about what the business is doing. Right?
Exactly.
Okay, let's get to our next question. This one from Koresh. Koresh wants to know, what's the best investment you ever made and what did you learn from it?
Funny story. So the actual, like technically the best ROI that I've ever received from an investment was a NFT of a llama. Wow. It was a llama JPEG. I think I bought it for $200 or $300, and ultimately, in the grand scheme of things, made multi 5 figures from exiting the position. Which
not bad for llama.
I was about 20 years old, so that was incredible when I was in university. What did it teach me? Is that in general, the crypto and the NFT space and all the alternative asset classes are just ridiculous, and nothing makes sense in that world. Still, it was really, really bad when that was happening in 2021 with the hype and the Bored Apes and the whatever going on. But ultimately, that's kind of the lesson I learned, is that I would much rather have confidence and invest in things that I have confidence in for the long term that are not propped up by hype cycles or things like that. It's the same with Pokemon cards or buying Labubus to go and flip them. Like, I'd rather just invest in things that I know are going to stick around. But I mean, it turned out well, but that was very lucky.
I think a lot of young investors might have the impression that you have to take crazy risk like that in order to get ahead, just because like how expensive life is these days. Yep. What's your take on that?
I don't think so. I don't think you need to, there's different types of risk. So risk with investing the money that you already have, or is the risk, taking a new job opportunity or leaving one to go and start your own thing and try to increase your income. So I think on the investing front, and when it comes to, taking your money that you already have and making it more money, I don't think you need to be risky. And I frankly don't think you should, because if you do something risky with that money and you lose it, you're gonna put yourself back a lot in terms of the compounding, and every month that you're leaving that money in the stock market or something that can compound and grow consistently, like it's a big opportunity cost if it goes south. And so I think there are certain areas in life where young people like myself, can take risks. For me, it was starting my own company, not taking your classic whatever corporate internship that most students would. And so I think taking a bet and a risk on yourself on that front is okay, but I wouldn't go down this rabbit hole or convince yourself that you need to go all in on some meme coin or an individual stock and go 100x your money. That's not the reality, and the reality is that most people lose money, and the success stories that you hear are major survivorship bias. And yeah, so just take it with a grain of salt.
Yeah, nobody brags about losing all their money in a random coin somewhere. Okay, that's that fair point. We got time for one more question. Let's get to it. This one coming to us from Yasha as well. How do you value your investments? Actually, I think we asked this one already. The fundamental metrics, original research.
Yes.
Let's just expand on this though. On the fundamental metrics side of things, what do you like to key in on? Because there's a lot of metrics out there.
Yeah, I mean, it changes, and I think it really, really changes depending on what industry you're investing in. If you're just looking at PE ratios, for example, in stocks, and you're investing in the tech sector right now, obviously they're going to look unattractive. And so I think it really, really depends on which industry you're investing in. If you're looking for value stocks, growth stocks, dividend paying stocks, there's so many different metrics to talk about. Ultimately, I think my personal opinion is that depending on your investing strategy and your goals, you should be investing in a certain subset of asset classes or stocks. And from there, you should define key metrics that mean the most to you. Again, you can use outside research to help you, but ultimately there are so many to look at. But there are only a few key ones in each, individual sector or niche that you have to focus on. But I think that's a very broad statement to make, only look at PE, only look at, acquisition costs and LTV and all. It's too much of a blanket statement for me to make confidently.
Right. Yeah. Good. Well, I mean, that's some good nuance for people to consider. We appreciate you fielding all those questions, Matt. Great job.
Of course.
Unflappable under the bright lights and the pressure of live viewer questions. Look at you. You did it. But we'll have to have you back on again too.
Absolutely. More than happy to.
Appreciate it. And of course, thank you again for our viewers tuning in. We always appreciate you tuning in. For those in our audience, make sure you check out next week's episode too. We got a good one for you. A veteran stock picker will explain his secrets to finding hidden gems with big potential that can thrive through tough market conditions, and good ones as well. He says these stocks have helped him build a $1 million portfolio before the age of 35. That's incredible stuff. I'd sign up for that. I don't know about you, Matt. That sounds pretty good to me. So anyway, so you don't want to miss that episode. That's all the time we have for this edition of the show. Real quick before we sign off, just an important reminder to our viewers. It's tax season and bank impersonation scams are on the rise, so you got to be vigilant out there. We've got fraudsters sending emails and texts posing as financial institutions. They're often asking clients to click on a link to confirm their account details or complete a tax form, including W-8 Ben requests. Watch out for that urgent language, requests for personal information, or unusual sender addresses, because TD will never send you an email or a text asking you to click a link to log in or submit some tax form. If you do receive a message like this, do not click it. Instead, report it to TD by forwarding the message or a screenshot of it to phishing@td.com. Everybody stay safe out there. Take care. Thank you for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.